What if I told you that becoming a top 10% American was not about having a yacht, a private equity portfolio, or even a seven-figure income? You know, what most people think it takes to be rich is based off feelings, not facts. Because the truth is, the number that pulls you into the top 10% of Americans is actually smaller than you might think. And yet, somehow still out of reach for most people, most Americans. So today, we're going to break it down, exactly what that number is, how to reach it, and why most people never do. Plus, what people think it takes to feel rich or even just to feel comfortable. Now, you can earn $250,000 a year and still be completely broke. You can earn $55,000 a year and quietly build your way into the top 10%. And the difference is never what most people think it is. So let's start with the top line number. According to the Federal Reserve's most recent survey of consumer finance, the top 10% of US households had a net worth starting around $1.22 million in 2022. Now, that's before all the recent inflation spikes, so adjusted to 2025 dollars, the new threshold is closer to 1.3 million. That's the number, but it's not your number yet, because net worth is a moving target. And more importantly, it's a lifetime game. The number you need to hit depends on your age, your goal, and how you define financial freedom. For example, if you're in your 30s, being in the top 10% of net worth means having around $350,000. If you're in your 40s, climbs up to around $700,000. Or in your 50s, you're pushing past $1.2 million. The older you get, the higher the bar goes. That makes sense. Compounding takes time, and most people's assets build over decades as they slowly accumulate there. They buy a house and invest in stocks, etc. But here's where it gets interesting. Schwab ran a national survey in 2024, and they asked Americans what net worth you need to be considered wealthy. And depending on the generation, the answers were wildly different. Gen Z said that you're rich at $1.2 million. Millennials said $2.2 million. Gen X said $2.7 million. Boomers said $2.8 million. Now, those numbers don't reflect reality. They reflect emotion and comparison, and sometimes delusion. But they tell you a powerful story because boomers, they grew up in a different world. They had pensions, affordable homes, and stable jobs. Millennials and Gen Z came up in an era of student loan debt, gig work, and a housing market that feels designed to shut them out. So of course their idea of wealth is shaped by struggle. And yet, here's the twist. Gen Z is starting younger. They're opening Roth IRAs at 19. They're trading stocks at 16, which I don't think you're allowed to, but they're doing it. They may face steeper challenges, but many are making smarter moves earlier, and that matters. Let's get back to what net worth really is, because people confuse it with income all the time. But those two numbers can be completely disjointed, disconnected. And I've seen people making $300,000 a year with less than $10,000 to their name, no assets, no investments, no plan. And I've seen someone earning $55,000 a year who quietly built a $400,000 net worth, chunk by chunk, brick by brick. Same economy, different mindset. And here's the formula. Net worth is all of your assets, your home, your investments, your savings, minus all of your liabilities, your mortgage, your car loan, your credit card debt. And that's it. It's not about how much you make. It's about what you keep and what you grow. And a lot of people look rich, but they're secretly distressed. Why? Because their net worth is tied up in home equity. If you own a $600,000 house with a $400,000 mortgage and have no other savings or investments, your net worth is $200,000. But if you lose your job, you can't pay your bills with your equity. You'd have to do a cash out refi or something. And that's house poor. That's a trap. You look successful on paper, but one emergency and everything starts to crack. So let's break the pattern. Let me give you 3 very real paths to $1.3 million. Scenario 1. You're 25 years old, and you're making about $45,000 a year. Not a huge salary, but you're saving 15% of your income, around $6,750 a year. And you're investing it in a Roth IRA or 401k with an average 8% annual inflation-adjusted return. Now, if you stay consistent, you'll cross that $1.3 million mark by the time you're 61. Nothing fancy, no side hustle required, just consistency. Scenario 2. You're 29 years old and you're making $100,000 a year. Now you decide to save 10% of your income, $10,000 annually, and invest it with the same 8% return. If you do that every year, you'll also hit that $1.3 million right on time at age 61. Again, not glamorous, but effective. Scenario number 3. You're 44 years old, earning $150,000 a year. So you're behind, but you're not out. You make an aggressive move and save 25% of your income, which is $37,500 a year. Even starting this late, you can still hit that $1.3 million by the age of 61. That's only 17 years. You're behind, but you're not out. And these are real numbers. not get-rich-quick schemes and YOLOs and the stock options. This is a core message of the video, because you don't need a perfect salary, perfect timing, or a perfect market. You just need to start. Just be consistent and avoid the traps that most people get stuck in, that they fall into. Now, first up is lifestyle inflation. This is where your income rises and your spending rises right along with it. New car, bigger apartment, better restaurants, streaming subscriptions you forget about after about 2 weeks. Suddenly you're making 6 figures and you're still living paycheck to paycheck. I had a friend go from 80K to 120K overnight, and the first thing they did was go and buy a new car, upgrade to a luxury apartment, and start traveling more often. 6 months later, they had less in savings than they did before their big raise. That's lifestyle creep, and it kills long-term progress. The second trap is the fear of investing. So many people sit on cash, waiting for the right time, the perfect time to time the market, but they're afraid of making a mistake. But doing nothing is the worst mistake of all. Fidelity ran a study showing that if you invested $10,000 in the S&P 500 in 1980 and stayed in the market through 2022, you'd have over $1 million. But if you missed just the 10 best days and your returns cut in half, you miss the 30 best days and you lose 83% of your gains. Time in the market beats timing the market, always. The third trap is analysis paralysis. I've seen people do nothing for years because they were overwhelmed by options. Roth IRA, traditional, VTI, SPY, HSA, 401k, index funds, dividend stocks. They're all in cash. It's overwhelming. Or worse, they get sucked into some meme stocks or crypto scams and just lose it all that way, right down the drain. Now here's the secret. It's better to be consistently average than sporadically brilliant. A basic S&P 500 index fund held for 30 years will outperform 99% of day traders. And let me pause and ask you something. What's your current net worth? Not your income, your actual net worth. If you don't know, pause this video and go calculate it. There's a bunch of online calculators you can use, an Excel spreadsheet, whatever you gotta do. Because if you don't know your number, then you're playing a game without a scoreboard. I personally track all my expenses in Monarch. Not sponsored, costs a little bit of money, but used to use Mint, but that was skilled. But it automatically generates your net worth. So if you're willing to spend a little extra money, it does most of the work for you. Now, once you got it, here's what comes next. Increase your savings rate. The average American saves under 5%. That's not wealth building. That's treading water, if that. You need to get to at least 15 or 20% or more. Start by cutting one occurring expense. Just cancel something, shop insurance, sell a car you can't afford, free up margin. Then automate your savings, then invest it. Dollar cost average into total market index funds or S&P 500s like SPY or VOO. Set it and forget it. Reinvest dividends. Keep fees low. That's it. That's the playbook. We spend so much time obsessed over income, credit scores, and how much someone paid for their house, but none of those numbers tell the full story. Income tells you how much money flows in, not how much money stays. If it all flows out, it's all for nothing. Credit scores tell you how well you manage debt, not how much wealth you actually have. But net worth, that's the scoreboard. It's your personal profit and loss sheet. Every dollar you save or invest moves it up. Every single dollar you owe drags it down. It's not sexy, but it's honest. Think of it this way. If I told you that someone drives a Tesla and lives in a $900,000 house and wears designer clothes, you might assume that they're doing well. But what if I told you they have $12,000 in credit card debt, no retirement savings, and they're 2 paychecks away from default? Net worth cuts through all of that. It's the truth behind the Instagram feed. One reason that people don't get started is not math, it's the mindset. If you grew up poor, saving can feel unsafe. Spending can feel like freedom. And investing can feel like gambling. That's not irrational. That's financial trauma. And if you feel ashamed of being behind, it gets worse. Shame turns off action. You stop opening your bank app. You avoid conversations about money. And suddenly 5 years go by and you're even further behind. The truth is, you don't need to be perfect. You just need to move. You need to do something. You could start with $20 a week. You can read one book. You can open an account and make one transfer. The difference between being stuck and getting rich is not some 10-step plan that you have to buy a course for. It's taking the first step. The rest happens because of momentum. And let's run the timeline. If you're 25 and invest $10,000 a year at 8%, here's what it looks like. Year 1, you have $10,800. Year 5, you got $63,000. Year 10, $156,000. Year 20, $457,000. And by year 30, you're up to $1.13 million. The first 5 years, they feel slow. But the back end, that's where compounding really goes vertical. The big lie that people say is that you need a high salary to get rich. It's simply false. Income helps, but it's margin, what you save and invest, that builds wealth. A person making 60K a year with 30% savings rate is going to retire earlier than someone making 180K who saves nothing at all. The second big lie is, if I just budget better, everything else will fall into place. Budgeting helps, but it's a defensive move. You can't budget your way into $1 million portfolio. You need offense. You need to grow income, invest aggressively, and build long-term systems, not just cut back on a coffee here and there. And FIRE is not a one-size-fits-all. There's the traditional FIRE where you aim to fully retire in your 40s, but there's also like Coast FIRE where you front-load your investing early so that your money coasts to retirement without needing more contributions. Then there's Barista FIRE where you semi-retire and work a low-stress job just for benefits. And Fat FIRE where you aim for $3 million or more to maintain a very comfortable lifestyle. The point is, you don't have to choose a rigid path. You just need some clarity. You need to know what your freedom number is. Maybe that number is 1.3 million, maybe it's 2 million. Maybe it's just enough to walk away from a job you hate and spend more time with your family, with your kids. That's still winning. So here's my challenge to you. Drop a comment below and tell me where you are now and where do you want to be 5 years from now. Be real, put a number on it. Let's turn this into a community of people actually tracking their progress, not just watching videos. And if you found this video helpful, please do me a favor for the YouTube algorithm. Like the video and subscribe, and maybe share it with someone who needs a reset. Because this is a winnable game, but only if you stop playing the wrong one. So I'll leave you with this. What if being wealthy was not about winning? What if it was about peace, about margin, about time, options, dignity? Imagine what your life would look like if you never had to check your bank balance before making a decision ever again. And that's what we're really building. That's why we're tracking our net worth. Even if you're at $5,000 today, it's the start of something. Track it for 12 months. You'll be shocked at what happens. Thank you so much for watching, and I'll see you next time.